we jump in, let's set the stage. Last week, the Federal Reserve made an important policy move. They reduced the federal funds rate by 25 basis points, and at the same time signaled a return to quantitative easing, adding liquidity back into the financial system. That decision has sparked a lot of debate about whether the Fed should continue easing or pause here. So today, Mark and I are going to talk through both sides of that question.
Well, this should be an interesting conversation, and call me the good guy, but I think the Fed should keep cutting rates. When you look at the economy right now, it's clearly cooling. Job openings are coming down, hiring is slowing, and certain sectors are already losing momentum. A few more cuts could help support growth and prevent this from turning into something way more serious.
I get the concern, but I think it's premature. Inflation isn't fully defeated yet. If the Fed cuts again too soon, they risk undergoing a lot of the progress they've made over the past couple of years.
But borrowing costs are still pretty high for both consumers and businesses. Lower rates would help people refinance debt, encourage businesses to invest, and keep spending from falling off a cliff. Those are all critical to keeping the economy on stable footing.
At the same time, asset prices are already elevated. Stocks are near highs, housing is expensive, and risk assets are frothy in places. More rate cuts could just inflate bubbles instead of helping the real economy.
Sure, but inflation has been trending downward. That gives the Fed some room to ease policy without triggering a runaway inflation spike. We're not talking about slashing rates aggressively, just nudging them lower.
But consumers are still spending. Wage growth is solid, and balance sheets aren't as weak as people feared. The economy may not actually need additional stimulus right now.
Well, I'd argue the financial system is already feeling stress. Credit conditions are tight, especially for small businesses and regional banks. To be fair, the reintroduction of quantitative easing should help migrate some of the pressure by improving liquidity and easing financial conditions. But QE alone may not be enough. Cheaper policy rates would further reduce stress and lower the risk of something breaking unexpectedly.
Another issue is credibility. The Fed needs to look data-driven, not reactive. If markets start to believe the Fed will always step in with cuts and liquidity at the first sign of slowing, that creates moral hazard and encourages excessive risk-taking.
But monetary policy works with a lag. By the time the data looks truly bad, it's often too late. If the Fed waits too long, a slowdown can become self-reinforcing. Less spending leads to layoffs, which leads to less spending. Get it? A small cut now could help prevent that spiral.
Or it could overshoot. Keeping rates steady lets the Fed see how the last move and the renewed quantitative easing work their way through the economy. More cuts now could mean they've done too much.
Don't forget the global angle. Other central banks are easing as well, which normally would amplify the impact of Fed cuts. That said, ongoing tariffs and trade frictions cloud the international transmission of monetary policy, blunting some benefits to exports and global demand. Even with that uncertainty, staying too tight relative to others can still strengthen the dollar and weigh on U.S. manufacturing.
That's fair. But if inflation expectations start to rise again, the Fed might be forced to hike aggressively later. And that would be far more painful than holding steady now.
Yeah, but I still think a little proactive makes sense. A modest additional cut acts like insurance. It's far cheaper to ease gradually now than to scramble with emergency cuts later if the economy slips into a hard landing.
And I'd say the Fed signaling they're done for now suggests they believe conditions don't warrant more stimulus beyond what they've already announced. Stability may be the best policy until clearer data comes in.
So, really, it kind of comes down to risk management, whether the bigger risk is doing too little or doing too much.
Exactly. And right now, I think the Fed believes patience is a safer bet. It's worth acknowledging that setting central bank policy is far more difficult than it often looks from the outside. The effects of rate changes and quantitative easing play out with long and uneven lags, and policymakers are constantly balancing dozens of moving data points. That complexity is what makes the Fed's job so challenging.
And with that, Thanks, everyone, for tuning in and watching the Financial Flash. We appreciate you spending part of your day with us. Have a great weekend, and we'll see you next time.
Educational content by the professionals at Styles Financial Services, delivering customized portfolios aligned to your unique wealth goals.